Well, hello, everybody. Thank you so much for jumping on here. I'm excited to jump on here and give you some information today. If you have any questions, make sure you go into the Q&A or the chat, and I'll make sure to go back and look at those afterwards. If I haven't answered those questions, we'll walk through it and answer the questions the best that we can. So this program just launched yesterday. So it's just fresh new information that we're getting, and any follow-up questions I'll make sure to send out as well. So this is for California, and this is the California Dream Program, which will allow 20% down payment that you will be getting in the form of a loan, which you will be paying back later, which we'll dive into here in a minute, to help you get into the home just to make it affordable. It is for first-time home buyers, so you do need to make sure that you're a first-time home buyer, which means that you haven't been on title to any property in the last 3 years. So as long as you haven't been on title, then you're considered a first-time home buyer, even if you owned a home, 5-10 years ago. So program eligibility, let's talk through this. So what we're going to go through is just kind of the high overview, and then we're going to look at some examples, and then we're going to get to the Q&A. So again, hold your questions or put them in the chat in the Q&A, and I'll make sure to review them afterwards. So in this program, you do have to be a first-time home buyer. You do have to occupy the property as your primary residence. That means that you will occupy the residence. When you sign your deed of trust at closing, it says your intention is to occupy the residence for at least 12 months as your primary home. Non-occupant co-borrowers, co-signers not allowed. So that means that you do have to qualify for the program itself. And there is home buyer education that you're going to have to complete. We'll talk about that. There's 2 different levels. And you can put your own additional funds in with the 20% down. So even if you're getting the 20% down, you could still come in with more funds in order to get you qualified to where you're comfortable with the payment. Now, it is a conventional loan, so the credit score does require either a 660 if you're under 80% of what's called the AMI, which is the area median income, which we're going to talk about more, or a 680 if you're over that 80% area median income, which we're going to go over as well. So you could see here, this is right now what the income qualifications are. So for this program, it does allow, as you can see here in Sacramento and Placer County, it's quite high, that you can have income up to $202,000 and still be eligible for the program. Now, we talked about that 80% AMI, area median income. So for Sacramento and Placer County, typically it's going to be $81,920. So that means if the income that we're using for qualifying is $81,920 or less, then you can have a lower credit score, and there's some other advantages which we're going to talk about here in a little bit as well. It is going to be specific to the property area as to what the 80% area median income is. So we'll look on the property areas when we're going through the pre-approval based on where you're looking to purchase as well. Now, this program is a little unique to other programs because it does have some additional layering. So on a normal down payment assistance, you may have a second or third loan, and you pay that back whenever you sell or refinance the property. On this program, because you're getting such a big down payment of 20% to make it more affordable, the program is a shared appreciation program. And we're going to walk through an example, so don't worry. And what that means is that when you go to sell the home, part of that appreciation you're going to pay back into the program fund. And so depending on which category you're in, whether you are over that 80% area median income or under it, is going to be a variance as to how much of that 20% you have to pay back and how, or the appreciation that you have to pay back. So let's say that your income is over that 80% AMI. So your higher income, you're over that 81,000 that we looked at. That means that you will get 20% for the down payment. And when you sell the home, you also have to pay back 20% of the appreciation. So you're paying back the 20% and the appreciation. However, on that 20%, you have 0% interest and 0 payments. That's what makes this program so unique and so affordable. And if you are under that 80% AMI, then that means that you only have to pay back 15% of the appreciation versus 20%. So you still get the 20%, but because you were the lower income, and that's at the time of qualifying. So let's say that you qualify and you're under the 80% AMI, and now 5 years later, you're making a lot more money. Doesn't matter. You still only have to pay back that 15% of the area median income, which is great. Now, there is what's called a cap, a shared appreciation cap, which means that, let's say that, the home appreciates a ton. Are you going to have to pay 20% or 15% of the total amount? So here you can see it's a cap at 2.5% of the original purchase price. So as an example, that means the shared appreciation loan. So that's $100,000 that you were given for the down payment. So let's say it was $500,000 for the purchase price. 20% is 100,000. And the original amount that they gave you, that 100,000 times 2.5 is 250,000. So that means that the maximum amount due that you would have to pay back is that original investment of 100,000 and then appreciation up to 250,000. So it would be 350,000. So there is that max. It's really nice because if the home values appreciate a ton or you're in the property for 30 years, there is going to be a cap as to how much of that appreciation they can get. Now, when is this going to be due? So the loan and appreciation is going to be due whenever you sell or refinance or change ownership in the property. So at that time is when they're going to say, okay, now the home is worth X, and then take the appreciation and the loan back at that point. Now, another question that we have to get is, well, what if we never pay back the loan? Now, it is a 30-year loan, which means when you make that last payment and your loan is paid off, it now is due. So you do have to pay it back after 30 years. If you have the loan for the entire time, at that 30-year mark is when you would have to get a new loan, or you'd have to pay back the 20%, and again, the appreciation at that point. So there is going to be always a time that you're going to have to pay that back. Now, let's walk through an example here, which is going to make it a little bit easier to understand. So this first example here is if you are over that 80% AMI. So again, you're 80 to 150% AMI income. So that means in Sacramento, you're over that 81,000 up to that 202,000. So you still qualify, but you're considered moderate income. Then that means that you're going to get the 20% of the purchase price as a down payment. And then that's what you're going to pay back whenever you sell the property, plus 20% of the appreciation. So let's look at this example here. So what you're looking at here is that you have first mortgage loan. So again, let's just assume this is a $500,000 purchase. That means $100,000 is how much you're going to get if you use that full amount towards, the down payment, closing costs, whatever you're using it. And then let's just say you're using it for the down payment. That means your first mortgage would be $400,000. So now your mortgage is $400,000. You took out a loan for $100,000. Again, 0% interest, no payment, deferred. And now let's say in 5 years, your home is worth $640,000 and you're ready to sell because you want to upgrade or buy another home. You have $140,000 now in appreciation because, again, it was $500, now it's $640. So that means that the homeowner's share of appreciation that's on here is going to be $112,000. And of that, and then the shared appreciation of that portion is $28,000. So the portion of your appreciation, which is 20% of the home appreciation, is $28,000. That's what you owe the program. So you have to repay them the $100,000 original loan and then $28,000 for the appreciation. So you're paying back when you sell the home $128,000. But here's what's really cool. Even though you're paying them part of the appreciation, you get to keep your equity. So now you have $142,000 that you've gained in this home. Versus, as we all know, when you're paying rent, you get zero, right? You get no return on that. So it's a really great program where even though you're paying back a portion of the appreciation, you're gaining a lot still here. And then that second one is if you're under that 80% AMI, like we talked about, that your income's under the 81,000, you only have to pay back 15% of the appreciation. So in this scenario, same thing, 500,000, 640. You would just pay back 121, and then you would have a little bit more equity, 149,000. So you get a little bit more that you get to keep in your pocket as a first-time home buyer at under the 80% AMI. There is education requirement. You're going to have to take 2 educations. Once you're in contract, we can get that information to you. There's no point in doing it now. You just do it once you get in contract. You do need to allow at least 8 hours for the education. It's online, as well as you have to have a phone interview with the representative just to go over the information. And it's typically about $99 for one of the educations, and the other one, there's no education on it, but it's just going over the program, making sure that you understand how the shared appreciation works. Property requirement. This is really cool because it does allow for the single family residence, condos, PUDs, also may allow for guest houses, granny units, or in-laws, which is really cool. And do have to make sure that the appraiser has comparables, so it can't be just one-off unique property. We do have to show that there's comparables in the area that also have guest houses, granny units, and whatnot, but that's really great that it'll allow it on the program. Manufactured housing is permitted. However, keep in mind, with manufactured housing, there's a little bit slightly different requirements that we'll have to look over, as well as we have to make sure that the manufactured unit was built after 1976 and that it's never been moved from one location to another, and a manufactured housing unit cannot allow for an ADU, only the single family residence. So it just has to be manufactured, built after 1976, never been moved from one location to another to meet those requirements. And then the condos do have to be have some basic requirements around that too. So if we're looking at those, we need to kind of talk about those a little bit more. Now, this is what's really cool about this program too, is some down payment assistance won't allow you to be able to refinance. So when you purchase a home in the future, when rates come down, a benefit is that you can refinance, which means you can pay off the current loan that you have and you can get a new loan that has a lower terms. And so you're able to get better terms in the future. So even when rates are higher now, when rates come down, you'll be able to get even better terms, but still was able to purchase the home for today value versus future value. Because when rates come down, home values go up, which make it more expensive. So buying today, if the rates are a little bit higher, you get a lower price home. And then in the future, when you refinance, you can get a lower rate. Well, this program will allow you one time to be able to refinance and still keep that second loan and not have to pay it off. So that what that means is they will subordinate, which means they will allow a new first mortgage and still stay in second position, which is what they are. So they'll allow you to refinance one time, which is really nice, because on other programs where it won't, it would require you to have to pay off that 20% and appreciation, which means you're stuck in that loan for quite a while. So really great that they're allowing it, and it is in writing. I made sure that I pulled this from the program requirements, specifically from the guidelines that says one time they will allow you to do that. Now, interest rates vary all day long. They're changing every single day. We have to pull them because it's so volatile when it comes to different interest rates, just like the normal market, but also with the down payment assistance. I just pulled this last night to kind of see where we are. Now, this is actually really, really cool, because when we took the initial training and got the information on this program, we were under the impression the rates were going to be much higher, but it turns out that they decided to keep rates at market. So what we're seeing here is actually pretty comparable to where rates are now, if not a little bit better in some cases. The 6.375 is a 30-year fixed rate mortgage for that first mortgage. So remember, you're going to have a first mortgage and a second mortgage. That second mortgage is a silent mortgage with 0% interest, no payments on it. So the rate would be on that first mortgage. So 6.375 would be the rate based on where they are right now. If you are under conforming loan amounts, which is 624. So if your loan amount is under that conforming loan limit, your interest rate would be 6.375. And if you're under that 80% AMI, remember you have some benefits. That's another one, is your rate's lower. So if you're under that 81,924, I think that's what it was for Placer County, then your interest rate would be 6% versus 6.375. So that added bonus. Now your loan amount can go up to the high balance loan limit in the areas that you're looking at. So depending on the area that you're looking at, it can go over that 624 up to a certain maximum. We can look at that for you specifically, but you can see here there is a fee for that. So you would have higher costs in order to have that high balance loan limit that you'd be looking at, which is standard on even normal programs. So just wanted to point it out so you have that information. Now, why is this a benefit? I am very much into numbers and understanding things, and I want you to see where the benefit is and kind of pros and cons of should I use this program, should I not? And as you can see here, I just put together some blanket information. This is not a guarantee to lend. This is not, subject to change. We have to look. So let's say that you purchased today at $600,000 using this DREAM program. So you can have $600,000 and your payment would be maybe around $3,908, including property taxes and insurance that are required in a home. And that would require, as you can see, cash closes your investment. Now, we need to talk about this more because our mixes is that you need to be prepared to pay, even if we can use the down payment assistance. Come out of pocket with nothing. You still have to pay more. We'll talk about that process as well, and your real estate agent is going to be able to clarify how much you need for a deposit. But let's just assume that you're able to put in an offer with only a $1,000 deposit, or roughly this $1,200 that's needed from you. So if that's the case, then at $600,000, you would have a payment of $3,908, and your investment could be less than $1,200 out of pocket. Crazy, because you're using that 20% for the down payment closing costs. Now, you could, if you have funds, say you have $1,000 or so, and you said, Kristin, I'd rather use this completely for the down payment and have mortgage insurance, which is included in this number here because it's not quite 20% down in this scenario, using part of it to cover your closing costs. But let's say it's a closing cost, $10,000, $12,000, whatever it is. Well, then this payment can be a little bit less than what I'm quoting here, and you can come in with those funds. This is just showing a way that you could potentially come out of pocket with very little. So we can look at those scenarios for you. But now let's talk about, assume I'm using down payment assistance. Let's say that I have the minimum down payment, which is 3% in closing costs. So I can look at a standard loan, which means I'm not taking out any additional assistance loans. At $600,000, what would that look like? Well, look at that. Your payment would be about $45.10, and it would require over $30,000 out of pocket. So that's why I want you to through benefit this program for two reasons. Let's say that you can only qualify for $3,900, but you really need to be at $600,000 to be in the area that you're looking to buy. Great program. Or let's say that you don't have the $30,000 to invest and you need help with the down payment closing costs. You don't have any funds, but maybe you started a great job or you have the income. Great program to use. Because as you can see here, you're going to be saving over $600 a month. So even though you have a loan that you have to pay back later in appreciation, $600 a month that you're saving and $30,000 for the initial investment. So really you're kind of leveraging the program to work for you. Your minimal investment that you have and the payment is more affordable and it's building you equity, appreciation, assuming the home appreciates, and you're paying down the loan balance, which is part of the equity as well. So really great program to look at for those that just can't qualify to a specific price point, don't have the funds available to be able to purchase. And as you can see here, let's just assume that you're paying $3,000 a month for rent with a normal 5% year-over-year rent increase. Look how much you paid just in 5 years in rent. So a lot of people are like, oh, I don't want to share, my appreciation. Well, you're already paying for it in the rears if you're renting. Meaning that you're wasting all this money. I mean, in 5 years, you already wasted $198,000, which is more than the appreciation that you're going to have to share if you were to purchase. So looking at it from that perspective too is either way you're going to be paying, whether you're paying for rent or you're moving forward. And at least this way you're getting appreciation. You have affordable mortgage. You get to do whatever you want to the house as far as like how you want to decorate it. And you can have, depending on what type you have, I know there's a lot of restrictions around animals too. Now let's just assume that in 15 years on this, using the down payment assistance program, your net worth in 15 years, assuming a 4% appreciation year over year on the home and paying down the balance is quite huge. So even if you're sharing a portion of that appreciation when you sell it, you're massively increasing your wealth and building your finance portfolio there on those. So how do I apply? So because the program just came out, as you can imagine, there's a lot of inquiries around it. It's a great program. I think a lot of people are able to benefit from this program that have been waiting to buy. Another thing that I do want to add is that we may be able to also buy down the interest rate from this program. That means that we can maybe get lower if we take some of that 20%. Instead of using it as a down payment, we buy down your rate, give you a lower rate to make it even more affordable. So great that you came on with that they're going to allow that as well, which is a one-off basis that we have to look at. I just want to let you know it's an option. So how to apply? Scan QR code, go to kristinloans.com. For the program, the specifics you need to know, you need to understand to be prepared for the program you can qualify for, or set up with a great agent to understand how to help you to have a side. So I'm happy to help set you up with that as well. So again, if you have any questions, feel free to reach out. You have all of my information. Please share this. Know this program exists or that they can become a homeowner, and that if you're able to share this out to other people, it's going to help them as well. So let me know if you have any questions. I don't see any specific questions here. I'm looking through. Answered that one already. Yeah, thank you for that question. I already answered all that question. How long does it take to qualify? So it's great to send in. Then we could switch conversation. Maybe a little bit delayed. There's so many inquiries right now, but know that you're in the right hands, you're in the right team, and you want to make sure that you're working with the right for you possible to experience it. And you can go and you can look at all my reviews. You can follow me on social. You can see all the information out there so that you know that you're in the right hands with the right team as well. So pretty quick. But again, we'll let you know if there's going to be a delay on being able to share that information. So you can follow me on social, Facebook, Instagram, YouTube, stay connected, get some additional information, get the QR code here, or you can follow KristinCooper.com if you have a specific question. Let's see, I have another question. Let's say if I already have a pre-approval before knowing this program, the contract, and with HEFA. So what I think you're saying is, can you go into contract with your current approval, not qualified for this program, but then switch into this program? That's going to be a question that you want to talk with your real estate about. It depends on how you write the contract with your income. Whatever the terms are that you have accepted, but it's not under this program. For free, and whatever you're still in contract. For instance, if I have somebody may benefit them, sure, I can look at this program, we can reserve, we can move forward. I can call the agent, let the agent know, hey, I want to go over to this program, and that way the agent do you want to make sure that you're in contract, or if you can't, if the seller is not willing to allow you to go that way, if they're trying to switch it, then we can address it. But it is possible, sure, it's possible. Oh, and lastly, are the funds reserved? So yes, there's about $300 million allocated to the program, which seems like a lot of money. Believe there are not only 3,000 loans. So we anticipate the funds probably will be running out because it's one of those programs where it's not continuing. It's just once they've used the funds, we're done with the program. So it is something that you would want to make sure that you take action on now. As you can imagine, it's a great program. It's going to probably be gone soon. If you're in contract, we have to reserve funds right away. So you do want to make sure that you're working, which means that I can, not 80 different years free. I'm sure we're getting this programs, but I have direct access to this program where I'm able to register you pretty quickly. Versus if you're working with the bank or a direct lender, usually it takes several days before you reserve the funds. And that time, meaning that you can be in contract to purchase, and if you're not working with the right team, you may not actually have the funds reserved by the time that they're able to do it, and now you have to go back and cancel your contract. So it's really important making sure that you're working with the right team, again, that understands these programs, and make sure that you're on track, that you don't lose the program, lose the reservation, and or don't get properly qualified, because you're qualified as well as the loan officer understands the program. And so they could say that you're qualified, get into contract, submit it to the lender, and now you're not. So you need to make sure that you're working with someone that really understands the program as well. Great question. Let's see if we have any other questions here. How long is the pre-approval good for? So we'll just go in on these programs and we update your pre-approval every 30 to 60 days just to make sure nothing's changed. When we do our consultation, we'll go through and just make sure that nothing's changed, and that way we're all on the same page, and I don't have to re-pull credit every time to update your approval, so there's no impact there. And we'll make sure that obviously if the funds run out, we'll let you know, and then we'll have to look at other down payment assistance options in lieu of that to see if you qualify for those programs until they get more funds. Hopefully next year they'll come back out with the program again if it's successful, and give some additional funds allocated. They try to get more funds, but that's all that they can get, unfortunately. So great question though. Any other questions? I don't see any other questions here. We're almost to the hour, but thank you so much for jumping on here. Wanted to make sure you understand how this program works. Again, to see if you get qualified, go to KristinLoans.com so that we can figure out what you qualify for. Make sure you put in the questionnaire that you're interested in the California Dream program, so that we make sure that we're reviewing the right options and scenario for you, and make sure that we're getting you all the right information so that you have everything that you need. So super excited. I think this is going to be a great program if it's something that you're interested in, and looking forward to going over all the information with you.